Real talk, real people, real deals. Let's see what today's market reveals. Right here on the Banker D Show.
Good morning, ladies and gentlemen. This is Dave D'Souza, aka Banker D, coming to you live from Glendale, California. Thank you for joining our show, and a very happy and prosperous and safe New Year 2026 to all of you. I'd like to welcome as my guest of the show today, Mr. Zach Schneiderman. He's an insurance specialist, and I've had the pleasure of working with him for quite some time. Just want to give you a quick recap on the markets from last week. Interest rates did a very slight improvement of about 0.125%. So our par rate for the ideal profile is now 5.75%. That's the lowest I've seen it in the last few months. And the stock market had a pop-up of about 1.5% net from Friday of close of last week. This was the first full trading week for 2026, and markets look reasonably enthusiastic, and there was a little bit of a return to some of the tech. The thing that drove interest rates was a continuing concern over the weakness in the jobs market. And there was a hopefulness on Wall Street that with the Supreme Court ruling coming on tariffs, we might see some relief on tariffs, which will hopefully have a positive impact on prices, inflation, et cetera, which will allow the Federal Reserve room to lower rates further. That said, as a quick recap of last week for both stocks and bonds and interest rates, without further ado, I'd like to introduce Zach Schneiderman. Again, he is an insurance professional that I've had the pleasure of working with for very many years. We've had many clients that we've worked with together. Zach, welcome to the show.
Thanks for having me.
Well, please give us a little bit of update. I know you recently sent an email to me with a lot of information, and there's so much changing in the insurance industry right now. Maybe you can give us a little bit of perspective on what has developed, what has evolved in the insurance industry. I should say devolved in the insurance industry from about a year ago to maybe now. What can we maybe expect for 2026 going forward? And as someone who is in the industry, what challenges and what hopes do you see?
So I think we're actually in a better place than we were a couple years ago or even a year ago in the insurance market in California. We're starting to see that the market's solidifying and correcting itself. Now, obviously, that means rates have been increased because that's what was holding insurance carriers back from opening their markets. But we're seeing insurance companies starting to come back into the market. And so some competition's coming back. We're seeing easing of underwriting restrictions. So you're still seeing some carriers that aren't coming back yet. So the market's not fully restored, but I think we're on the right track to getting there. And that comes from just a lot of easing of pains that insurance companies had that were keeping them out of the market.
I remember a time a few years ago when you could get a very nice home insurance policy for somewhere around $1,000 to $1,500 a year, which would cover your home. And now we're seeing a significant increase to that number. What do you see as the primary contributions to that? And where do you see that going over maybe the rest of 2026 and into 27?
Yeah, so I think it's really a combination of those factors. Regulation and over-regulation was part of the issue, but then a mounting of losses. And whether we say it's the massive catastrophes that have just been increasing. I mean, we've had so many major wildfires over the last several years that aren't what historically had been seen, but are now becoming just an ongoing trend. And then you factor in other types of losses like non-weather water losses, where we see a lot of pipe bursts and major water claims. And so what insurance companies say is that there's an increase in severity as well as frequency. And when frequency and severity are both high, they're paying out a lot of funds for claims, and they need to adjust rates for that change in the trend. And because of the regulations that exist in California that prevent insurance companies from just raising rates as they see fit or need to, insurance rates didn't rise at the pace that were necessary to keep the insurance carriers in the markets for many years. And over time, the insurance carriers were just becoming unprofitable in the state of California. So you might see that like name an insurance company and they were profitable and you're like, oh my God, they have record profits. Except they were losing a lot of the profits in other states to the losses that they were mounting in California. At some point, they felt there was a need to correct that trend and say, hey, look, we're not going to keep California losing a majority of the profits that the rest of the country was having, or forcing other states to increase their rates to make up for the losses in California. And so it was time for a global reset, or at least a statewide reset on insurance rates. And so what we used to expect and had gotten used to in terms of what insurance would cost for a home or even auto insurance, I think we need to adjust our expectations that
In
this
other words,
is the new
maybe
norm.
we were being spoiled a little, you think? Is that kind of what you're
I mean, I think we had it good. Um, we weren't paying what the actuarial data said needed to be paid in order to justify what the risk the
understood?
insurance companies
Understood.
were
In
taking.
California because of the regulation.
Yeah.
And of
Yeah.
course, sorry, go ahead.
So the regulations in California are pretty unique compared to the rest of the country. And in California, in order to raise insurance rates as an insurance company, you have to go through multiple steps and get the Department of Insurance to approve those rates. And what they use to leverage that, and what you're allowed to leverage, is justifying why you need a rate increase is one thing. But then if you need a rate increase over a certain amount, there's consumer advocacy groups that all they do is fight insurance rate increases. They don't even care if it's justified. They're just going to fight it no matter what. And it really makes a lot of hurdles for the insurance companies to get what they need to survive. And if you're asking anybody if it's worth investing in something for the risk that they're taking, if it's too much risk, people don't want to make that investment. And at some point, California became too much of a risk for insurance companies.
If you're allowed to comment from your perspective on Farmers as one of the largest carriers in the industry, would you say that what you've described is fairly true for them in the same sense that they were regulated to the point where the increases that they should have been able to put over the last several years have not been able to be put in place because of regulation?
Yeah, so obviously I can't speak on behalf of the insurance company, but I can speak from my experience and my
Yeah.
understanding of the industry.
Sure.
Um, it was difficult from an insurance perspective, from the carrier's perspective, and I don't think Farmers was alone in what they were feeling. I mean, there's reasons why you see State Farm hasn't re-entered the market, and other major carriers have still stayed out of the market and are waiting to come back in. Insurance companies still haven't gotten what they need, and we're talking about several years later going through this crisis. It's until the regulation process changes and adjusting rates becomes easier when things happen on the fly, it shouldn't take that long to get approvals. And when you can't adjust to markets in a reasonable time and adjust as needed, you're going to have to shut down your market. It just makes sense what insurance companies did.
That's a good feedback, and that's a great input as to how we've gotten from where we were. I think a lot of people, the general view is, oh, insurance companies just love to raise rates. And it's important for consumers to realize, I think, the whys. What's behind that? It's not just the insurance company trying to make more money. Like, as an example, I'm sure there are many people listening to this podcast right now, or will be listening to this podcast, that might say, oh, I didn't realize it was sort of a catch-up thing. I didn't realize that rates should have gone up, but they didn't go up as much as they could. So that's why they seem to have gone up more steeply, combined with the deregulation, combined with, at the same time, a lot of losses because of natural disasters that have happened, and they all sort of dogpiled at the same time. On a separate note, switching gears, unless there's a little bit more you want to say there, typically, when we open an escrow, I'll have a client come in, and one of the first things, especially now in this environment, the first things I do is, hey, do you have an insurance person? And if not, I'd like to connect you with Zach, Team Zach at Farmers. He's someone that we've worked with for many years. You really need to take a look into what the home insurance is going to cost you, because it may be a little bit more of your buying decision than it might have been 5 years ago. So when we send you and Team Zach at Farmers there, when we send you a client, a name and a phone number, says, hey, these are dear clients of ours, they're getting into escrow. Can you please help them out? What is your approach? Like when I get a client, I review credit, I review income, I review assets, I review their financial profile. What is the first steps and what are important steps that clients should realize you're going to take as an insurance professional to take them from entering an escrow with no insurance to what is the most effective way to get them a policy that they can close with that satisfies the lender, but that also covers the client's needs and an affordable way that does whatever we can to keep the premiums down.
Yeah, so, you know, try and take a holistic approach. So when we're talking to folks about their needs, we say, hey, are you a first time home buyer or have you been through this process before? And then we're going to get the property address, their personal information, and we're going to start the quote, but we're going to start walking them through things. And our objective is not just to talk about the homeowner's insurance that they need, but how are they approaching insurance in general? Do you look at insurance from a perspective of it's a necessary evil and I just want it, I want to satisfy the loan, but I really want a cheap policy and I'm willing to make some sacrifices in order to have that? Are you someone who, wants every bell and whistle? Let's add every endorsement possible. And then how do we take care of trying to find that happy medium between all of this, right? How do we leverage deductibles and discounts? So one of the biggest things we've changed in how we approached our clients, or at least from our standard, I used to use a $2,500 deductible is what my standard quote would be. If someone said to me, well, what do you recommend? I go, look, if you can afford a $2,500 deductible, that's what I used as a, you know, as a bar for myself in the past for many years. And we sort of pushed that to now we're using more $5,000 deductibles and higher. And we're talking to people about how, maybe insurance now is more of a catastrophic product than using it as your maintenance and small claim matters. And I think that's part of what's shifted, but helping people understand that homeowners insurance isn't something that you plan to use every year. You get a ding in your car, you want to file a claim and get it repaired. You get in an accident, you're absolutely filing a claim. But at what level do you want to start adjusting the risk you're willing to take and maybe setting a bar for saying, I'll start to manage some of the own maintenance and small things that happen at my house. And so I'm going to take a $10,000 deductible. Or if you're buying a high value home, we're typically talking about a 2% deductible on the dwelling amount. And that's one of the ways that we're helping people see that difference. But, then we talk about how to leverage other opportunities. Like, let's talk about bundling your insurance. I mean, if you're looking at buying each product in and of itself, it's hard to get the best possible rate from any one carrier if you're not trying to bundle. And the other thing is when you have something that goes wrong, these things aren't all independent. I mean, you own a home, you own a car. If you get in a car accident and the accident is sizable and you don't have enough coverage,
They could come after
someone
you.
who, yeah, judgments can apply to all sorts of things, and how people collect those is really up to the courts and the jurisdictions around. But if someone owed you money and you had an opportunity to collect it, you're probably going to be aggressive about it. And so our approach is, how do we help you insulate yourself in these instances as well? You're going to own this beautiful home that you're thinking probably is going to be your largest investment in your life for most people. And yet you're going to leave it exposed because you don't have quality auto insurance. That's something we want to take a look at and discuss as well.
Yeah, I think that's an important part because I've had clients, fortunately very few, but if you have an accident um, that has nothing to do with your house, you happen to be out driving and there's an accident and something happens, these things happen. And the amount of claim that an attorney may try to go after that may be beyond what the limits of your policy are. If you have a house, if you have retirement, if you have other assets, and we don't need to go into details about that now, but that is certainly something that you should speak with a Zach or an insurance professional about. Um, I think more of a holistic approach to the insurance. What's the old adage? Hope for the best, but prepare for the worst.
Yeah, and I think that when we talk about how things have really changed and why rates have risen so much across the industry, whether it's your home or your auto, we always talk about fires when we talk about homeowners insurance in California, but a lot of people forget that non-weather water damage claims are probably more frequent than fire claims. We get lots of pipe bursts. But then the other missing element is the liability claims. Look, you have a home with stairs and someone falls down the stairs. You have a pool and someone gets injured in the pool. these claims become very large claims the second someone
Sure.
engages an attorney. And, what used to be on the auto industry side, soft tissue damages like whiplash are now moving in the direction where the lawyers have found that traumatic brain injuries, which are concussions and other things, those are big ticket items that the juries are awarding a lot of money to. And so we're seeing a different approach from lawyers, and the insurance companies haven't been able to adjust their rates to accommodate for that, or found ways to carve out things in their policies that change that. So that a change in legal approaches has also changed the way insurance companies have had to address things because they've gotten hit in claims from the liability side.
Let's say somebody has a small pipe burst in a wall and they file a claim and then that ends up, but is there some sort of a blacklist or list that like either the home or the person that made the claim goes on, whether the claim is paid or not? And how does that end up affecting the long-term insurability either for that particular homeowner or someone who's never made a claim to actually try to get insurance on that home?
Sure. So obviously, in the world of big data, everything's available through consumer reports for the most part these days, and insurance companies are running those in the background, whether you know it or not. In some states, they run your social security number, and run credit and things, but that's not the fact in California. But so what we have to deal with here is, look, there are claims databases that properties and insureds, when you file a claim, it opens a claim, and I think it's like LexisNexis, Clue reports, things like that. And so claims stick with the property and with the homeowner that filed the claim. So if you're selling a home and you filed a couple claims on it in the last 3 to 5 years, that claim is going to be an issue for the new buyer. It sticks with
Even
the
if they've
property,
never made a claim on a home.
even if the new buyer hasn't. And then as the seller, if you're going and going to be buying a new home, that claim is going to follow you to the next property you're
Even
buying
if
as
that
well.
property never had a claim filed on it.
Correct, because you have a claims filing history.
Correct.
And you have a history because it has to do
So
with
the
how you
history
maintain your
follows
properties.
the homeowner and the house.
Yeah. Yeah, it's sort of like pre-existing conditions that used to exist in the medical industry, right? If a pipe's burst at your house and you've had a claim, and let's just say you haven't replaced all the pipes in the house, which most people don't, they patch it and solve the problem. Those pipes probably just have just as many issues. That's just where the pipe broke. So you fix the weakest point that broke and hope everything is good. And then again, another pipe burst. So pipe break. So the statistical information typically is that a property that's had a claim is statistically higher to have another
Higher
claim within a
probability.
certain
Yeah.
period of time. Yeah. And the same thing goes for the person who files claims is there are frequent flyers in the claims realm, and then there are those who just don't file claims, who look and go, you know what, this isn't big enough for me to file a claim. I'm going to handle it as a maintenance issue on my own home. I know that taking care of my home means I got to do certain things, and I'm just going to patch this $3,000 problem on my own rather than opening a claim. And we see it all
And
the
that
time.
might save you more than $3,000 in the long run.
Or on the ability to sell your house, because
Correct.
is a buyer not going to come from their real estate broker and try and negotiate the terms when they find out that the property's harder to insure, it's more expensive than it would have been without the claims? Are they not going to come back and maybe ask for maybe something off or a better deal somewhere?
This is all really, really valuable information. And for those of you who have, we're going to address a couple of questions here from our audience, but let me start with those, and then I'll give you information about how to circle back if you want to get more information on insurance and how we could connect you with Zach. This is sort of a joint question. Why is it so hard to get homeowners insurance in California? And what do I do if no one will insure me or my home, the home that I want to buy?
So, I think we sort of addressed a little while ago some of the reasons why it's so difficult. But to recap, we're dealing with regulation changes and the market constricted because it wasn't advantageous and profitable for insurance companies to operate in California in the way they were for many years. And it finally hit a breaking point, and the insurance companies decided to say, hey, until this is resolved, we're just taking our gloves, our bats, our balls, and we're walking away. Some insurance companies decided to stay in the market and brave the tough times. That's one of the things that happened, as a farmer's agent. I was lucky. We were one of the companies that decided to stay and be committed to the California market regardless, and try and work with the state agencies to just correct things that we needed to correct. But some companies decided to just pack their stuff up and leave, and are negotiating whether they're going to come back or waiting until they get what they want to come back. And so when you lose the competition in the market, you're going to find it's harder. Insurance companies don't want to be the only carrier writing insurance. We don't want every home in a small vicinity, because that puts a lot of concentrated risk on the books. And when something happens in that area and you have that entire concentration, it's a catastrophic loss to your
Sure, one
company.
neighborhood could almost severely impact the
Correct.
overall
And
bottom
and
line
that
on an insurance company. And then
and that's
what?
one of the things insurance companies are evaluating these days, is how much concentration of risk they have. And that's why you're seeing certain areas where insurance companies are now just saying, hey, we've already reached our max in coverage in that vicinity.
To the second part of the question, where what does one do if they've gone to 2 or 3 insurance companies? They're just astronomical rates, or they won't insure at all. Are there any fail safes? Are there any backup options? Are there any state provided, anything that can help out people who are having a really hard time finding insurance?
Sure. So, as an insurance broker, the California Fair Plan is an option we always have available to us. So they are the last resort for insurance in the state. So when you cannot find coverage through the markets, they're there to provide access to an insurance product. It's got some carve outs, so it's a basic insurance policy. It's not as comprehensive as what you're going to get in the standard market, but it is there to offer coverage when you can't get it through the other markets. And the other thing is, there's non-admitted markets out there that are where we would go for more difficult risks. So whether you're in a high risk fire area that maybe they're still willing to write for a certain price, or you've had too many claims on that location, or too many as an individual, there are other markets that we can access that aren't available for the public just to go online or go get a quote directly from, that have to go through brokers that have access to the non-standard markets. And that's something we've had to do for a lot of clients lately.
Are you finding that a larger portion of your business is now trending towards fair plan? And are you typically finding that when you do a fair plan, are you having to do some sort of an additional supplemental or wraparound policy to sort of make sure that that covers a few of the other pieces that the fair plan doesn't cover?
So if it's due to a high risk fire location, we're going to use the fair plan when you can't find a standard market for the fire exposure, and then we can do the wraparound or difference in conditions policy to fill that. And that's not as difficult. But when you have too many claims and now you're not insurable by a standard market, the fair plan might be all we can do, and then we have to get you a liability policy, but you might not have coverage for water damage, for theft, some of the carve outs that the fair plan doesn't offer coverage for. Or we have to go to those non-admitted markets and see if we can get something. And sometimes they'll put a policy together for someone who's got water issues where they only cover so much water damage, and they put what's called a sublimit on the coverage. And other times they'll just flat out exclude something, but they have a lot more ability to adjust and say, hey, we're going to exclude this, but offer this in those markets, but you're going to pay a little bit more for that.
So fair plan doesn't typically cover a pipe bursting in your wall?
They don't cover any water damage.
Oh, gotcha. So it's basically fire, wind, and other things. And if you don't buy earthquake, then fire, wind, and hail, and all that kind of stuff. External natural disasters, but not internal stuff.
And even some external stuff they don't cover too. So,
Wow,
I
okay.
mean,
Good to
think
know.
about if you have, an issue, basically I tell people if anything that causes water damage, probably not going to be covered on it.
Gotcha. Last question here, and I know this is a little ambiguous because there's so many different locations, so many different types of properties. But for an average home that is in the city, we're not talking about fire. We're not talking about, up in the mountains. We're not talking about in a flood zone. An average home, let's say in California, an approximate $1 million-ish, let's say it's 750, 800 to $1 million-ish home in the actual city part of LA, where let's just say that neither the seller nor the home has claims on it. Is there some range of ballpark that you could anticipate, or is that too difficult a question to answer for a premium?
I think you you can't put every home into a single box when it comes to, hey, this is the dwelling amount or the value of the home. How much is an insurance going to cost? It really depends on the location. I mean, if you separate Los Angeles and then you go to Ventura County and then you go to San Jose or San Diego or Riverside, the rates are so different across each vicinity.
Mm,
And that has to do with, what is the risk, but also what are the claims histories that insurance companies are having in
got
those
it.
areas. So if you have a high crime area and people have filed a lot of crime claims, you might see a different rate attributed in that area, but not realize that that's what it is. And that's why when you're really looking at buying a home, it's important to understand the the issues of that community. And as we tell people, when you're picking a home, be understanding that in, the insurance rates probably are only going up over time. Unless you've got multiple claims and they're going to fall off. The idea is, that every year there's a cost of inflation of how much it's going to take to rebuild the home. So you need to be prepared for it to be increasing at a reasonable percentage every year. But then markets change over time. If crime starts going up in your area, or you start seeing that the homes are aging and you have older homes where a lot of pipes are bursting, that might happen more frequently. Or if your neighbors and people in the community are filing a lot of claims and the insurance companies are noticing that in that zip code or that region that they're paying out a lot more, they're going to try and adjust rates so that they can still be profitable in that location.
Yeah,
And that's
important to
something that's going to happen over time.
Yeah, and that's important to take away is you could have the identical home in identical circumstances in the middle of a city in 4 different counties and have 4 different premiums.
Yeah, or even 2 blocks away from each other, because one could have a different risk factor for
Mm,
how far away it
mm.
is from brush, or how close a fire hydrant is to the home, or how far you are from the fire department, or if there's a cul-de-sac and you only have one mode of ingress and egress from the home. So a lot of these factors go in, and that's why each home is unique to itself.
Well, Zach, I want to thank you very much for all the valuable information. Obviously, we've been working together for a long time, and I appreciate you and your team there. If any of you out there have any questions specific to insurance that we didn't address here, or you're thinking that maybe you want to reevaluate your insurance perspective, please reach out to us. Zachary is Zach Schneiderman with Farmers Insurance. And of course, you can reach out to us and we can connect you with Zach. Zach, I want to thank you for all the valuable information today. I also want to thank our producer, Amy, for her help in putting this whole thing together. I want to thank you all, and I want to wish you a very, very happy, prosperous, and safe new year for 2026. Thank
The
you.
pulse of the market, the sound of the street, Bank of D.